Welcome to Yield Nerd, an educational show about how you can acquire and manage yield. All right, Yield Nerds, episode 145. This one has a story behind it. It is about two enormous retailers, Walmart and Target. Let's get into it. Most importantly, I am incredibly honored that we now have more than 410 subscribers. Thank you for your support. And if you are new, please use the Income Investing Roadmap. It's a playlist that organizes this show in a sequential manner. Last but not the least, remember to verify I am wrong. I am no expert. I cannot see the future. I share my education. Use your own judgment. Well, the episode today is divided into four parts. One is the market temperature. We'll go see how the market is doing and how my little portfolio allocation is doing. And then we'll talk about the tale of those two retailers. As you can see, Walmart is a massive giant, and the Target superhero looks very sorry there, clinging on to that cart while Walmart takes all the money. Whoa, you look really strong, dude. And then we'll look at the latest earnings season and see if there are lessons learned, and then I'll share my trades. Well, before I go any further, I want to make sure you know that I am not an investment advisor. This is not tax advice either. There is no product being pitched, and I don't do politics. Well, I will say I'm pleasantly surprised that my portfolio continues to do very well. The last 3 months delivering 16%, and you can see that I'm hovering way above any of the market indices. And it probably is a combination of luck and a couple of good decisions. We'll see if I can continue that. Even on a yearly basis, I'm at 24.75%. Before I run around saying I am the best in the world, let me clarify that my entire portfolio, which includes fixed income and equities, is only at 5.39%. But most of that is state tax free, and that pays my expenses, and I'm happy with that. Now, I do some level of anticipation. Sometimes I'm right, and here is one where I was right. Right before the election, I went and bought a whole bunch of stocks that I thought would help with the storm recovery, and turned out they had a boost right after the election. But I got some feedback from you, the viewers, who said, "Are you sure you want to hold on after this incredible increase in value?" And so I dumped a bunch of them and I took profits. And as the market normalized a little more, I still kept the cash and increased. So it worked out very well. Thank you for your feedback. I learned from you. And if looking back at the whole year, I can see that I'm mostly on the positive side. 83% of my trades are, I take gains, and the rest of them I take losses, but a whole bunch of them right after the election when I did the profit taking there. So my portfolio itself, as I told you, I at one point had a very high allocation to equities heading into the elections. Again, when I say very high, it's 3%. And since then, I've dumped it, taken profits, and I'm at 1.5%, give or take. And so my equity allocation has a very different tone to it. It is extremely concentrated in consumer staples and industrials. I smell war in the air, so I invest in things that you cannot live without. That is just me. As far as my asset allocation goes, I'm mostly in treasuries, a little bit in investment grade bonds, and I do not do bad credit. So everything I have is pretty much AAA. And the 82% unrated is really T-bills, which cannot be rated because they are equivalent to cash. And my duration, for those of you who have seen this before, is extremely short term. I keep it that way so I can capitalize on market, events, so I can come in and out. So let me go to today's crux, and that is me admiring the Walmart superhero who just looks invincible. Wow, carting away that bundles of money, and the Target superhero can't even be seen. So the e-commerce giant, if you look in the last 3 years, for a company as big as they are, their market cap grew by 87%. That is just stunning. An amazing performance. And you look at their revenue, and their revenue grew by 5%. I guess if you're a big company and you grow by 5%, you are rewarded by a 100% increase in your stock price. So, hey, good for you, Walmart. And their earnings per share grew by about 6% compounded over the last 3 years. And their next quarter forecasted growth is 4.4% compared to the same quarter last year. So that is what they forecast. But hey, the stock market is handsomely rewarding them for that 5% growth. So I guess it's good to be Walmart. In the meanwhile, here comes this awful, terrible Target. Target is down 52% almost in the last 3 years. Terrible Target. I'm guessing their revenues crashed and burned. What's happening? Their revenues also grew exactly the same as Target by 5% in the last 3 years. Their earnings per share, however, lags Walmart. Instead of 5%, their earnings per share only grew by 1%. And the irony is they are forecasting their next quarter about 3% less than the same quarter last year. So clearly not a growth company, but the market is beating them to the curb. It is terrible. So I thought I would dig deeper and understand what is so bad, and I need to learn a lesson or two from this. What you're seeing here, the yellow line, is Walmart. Look at that fantastic performance in the last 3 years. And the blue line is Target, absolutely getting pummeled, a 20% drop a week ago when their earnings came out. They got absolutely crushed. And so I wanted to get underneath the fundamentals and see how mismanaged Target must be compared to the superb performance of Walmart. So I thought I would look at fundamentals. Let me make sure I check my screen here. The right-hand side is Walmart. The left-hand side is Target. When you look at profit, return on asset, return on equity, return on investment, it looks like Target is the better of the two in everything except debt. Walmart isn't exactly debt-free. Walmart has debt to equity of 50%, except Target definitely has a lot of debt. So they're getting punished for debt. What about valuation? Please, I am trying to adjust my screens here. I'm not sure what's going on. So earnings per share is higher for Target. Price to earnings is a quarter of what Walmart is for Target. Even the forecasted price to earnings is a third. Price to sales, it's much better for Target. Price to book is much better. Price to cash flow is much better. You look at something like this and go, what is wrong? Target is cursed. And Walmart, in the meanwhile, is having a Cinderella ride. Good for you, Walmart. I'm happy for you. But Target, you have my attention. You look a little bit cheap here. So I looked at their growth. I see what's happening. So their 1 year growth, Target barely grew, while Walmart, being as big as it is, still grew at 5%. And that is what they are being punished for. And the earnings per share is growing in Target. However, as you can see, the real challenge is the growth forecast, which, is done by experts. So I always believe the experts. Hint, hint, just kidding. But the experts believe that the upcoming year, Walmart is growing their earnings at almost 12%, while Target is going to have 2% less in earnings. And that's a pretty interesting forecast there. So let me read that one more time. Walmart is going to grow earnings by 12%, while their sales increase by 5%. So somewhere in there, magic is happening at Walmart to sustain the valuation. And so I kind of look at their forecasted sales for next year. They think their sales are going to go up by 4.4%. But the industry experts expect their earnings per share to go up by 11%. So what I think? I think they're going to have a bunch of robots decrease salaries for people, and that is how they're going to do it. I'm guessing, I don't know, but that is what the data indicates. So let's look at profitability. Once again, when it comes to debt, Target has problems. No question about it. However, when it comes to cash on hand, agility, Target and Walmart can go head to head. Return on invested capital, Target actually has the edge. Now, what about profitability? I am again trying hard to not adjust my screens and having trouble comprehending it. Profit margins are higher at Target compared to Walmart. Cash flow margins are higher. Book value per share is higher. The enterprise value, to put that in perspective, if you went and bought all of Target's stock and you took the money in their bank and you paid off their debt, remember debt to equity of 99%, you would have spent $69 billion. If you tried to do the same for Walmart, which has a 50% debt to equity ratio, it would cost you almost a trillion. In other words, Walmart has a much higher enterprise value. It will take a lot to move the needle at Walmart. 70 billion will buy you the house for Target. I am kind of thinking about who has 70 billion lying around. Maybe there is somebody whose name rhymes with Schmoren Snippet. I will let you figure out who that is, but that name comes to me. If I was working for him, I would say, boss, what do you think of this? On paper, they are better than the other retailer. We may be able to bring them some efficiencies. We got 350 billion in cash sitting around, and here is a stock that just crashed by 20% and is head over heels better than Walmart in every which way. Just a thought, I don't have the connection with Schmar and Snippet. In the meanwhile, Walmart said, we had such a good quarter, we are going to hike our salaries and give them bonuses. Let me put that in perspective. Next quarter, the forecast from Walmart is to increase sales by 3%. The industry analysts expect earnings per share increase of 11%. So how do you take 3% increase in sales and translate it into 11% earnings per share? You increase expenses. That is what is happening at Walmart. So I'll let you process what that means. But hey, what do I know? So what did I do in this latest earnings season? I learned a lot about how shorting the market creates these short squeezes. And there were a couple I flagged earlier. One of them was POWL. You may remember Mr. Thomas Powell, owner of Powell Industries, dumped a whole bunch of stock a week before earnings came out. He's allowed to do it as long as he publishes it, and you are the better for buying it. Well, surprise, surprise, the stock crashed a ton. And so I stayed out of Powell, but it turns out that the market didn't stay out too long. Literally a day later, the market came and bought a bunch of that stock back again. But it was very interesting for me to see when there is a lot of insider sales, how do you react? And that was a lesson to me. There was another one that I did not have the chutzpah to play, and this is the $300 frying pans at Williams-Sonoma. And I didn't think Williams-Sonoma was going to beat earnings, and turns out they beat earnings. And they had a lot of shorts on their stock, and their stock went up by 32%. That is insane because that is how much there was a short, and so the short squeeze happened. And so I was enamored by this. I said, how the hell did they sell $300 frying pans? Now, I don't know if their frying pans are $300 or not, but I certainly don't buy my frying pans from Williams-Sonoma. And so I read their quarterly earnings report, and here is kind of sort of what it says. Well, a quarter ago, we said we will blow our sales by 4%. We are going to sell 4% less than same quarter last year. Turns out we beat expectations. We only missed by 3.5% compared to last year. We didn't miss by 4%. And that is considered beating your earnings forecast. How nice. And so the short sellers were forced to cover their basis, and that ran up the stock. And I take that as a very interesting lesson for me. So, I did not want to buy Williams-Sonoma because I thought there is no way they can beat earnings. But you have set the bar so low, then maybe, next earnings season, I should think different. I would love to hear your thoughts on that. Having said that, let me go over to my trades. And as you can tell, in my world now, the Target superhero is the one pushing the grocery cart. And I'm leaving the great, amazing Walmart superhero behind. Yes, I bought some Target. And this might be a day old, but it's already up a couple 3%. I still have USLM. That is the gift that keeps on giving. I've doubled my investment there. I still have Calmain Foods, which is in the food side. I have a bunch of military stocks that are doing well and some medicine. And there is another one that I picked up, and I call that the fallen angel, which is Google. And Google has more money than you can throw a stick at, and their stock crashed by 5% because there is this whole notion that they're going to get broken up. And who knows whether they will or they will not, but there is some volatility when their stock crashed by 5%. I went in and put a position there. Those are my trades. And I've crawled back into my fixed income hole again. And 55% of my portfolio will mature again the day after Christmas. So I expect some fireworks towards the end of the year. And until then, I'm going to just nibble here, nibble there, and still stay at a very low allocation to equities and wait and see what the end of the year brings. Hey, even a broken clock is right twice a day. Don't believe me? Make sure you check your work and make sure you trust your instincts, not mine. Thank you for watching Yield Nerd. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.